I think the positive news in the short run is that the macro news flow still seems to be quite good. The ISM surveys and generally the earnings momentum is improving. So that's a positive. I think the other positive in both the short-term and a long-term perspective is that people are still quite pessimistic, or investors are still positioned quite conservatively. Specifically, the Merrill Lynch Fund Manager survey that came out last week showed that cash levels in mutual funds is around 5.8%. That's the same level it was when, or post-Brexit, and also around 9/11 levels. So investors are quite cautious already.
And they're quite cautious already, keeping cash on the side and just waiting for the elections to get over with, and
Quite
also
possibly,
with the Fed decision in November and December to be over with as well. One of the asset classes that you've focused on recently is high-yield bonds. They've performed well against equities, but you're saying, hold on, there are some key risks out there as well, and in fact, you're now underweight in high yield.
No, actually, we've still got an overweight position, but we've been thinking
You've been
about...
trimming it.
That's right, I've been trimming it and thinking about scaling it back. Well, I mean, firstly, risk compensation is nowhere near what it was at the start of this year. We've seen an incredible performance of high yield from the trough, or year to date, it's up around 14%, from the trough even better. So spreads have come in from around 900 to about 500, or a little bit under 500. And that is partly correlated to the stabilisation in the dollar and the stabilisation in the oil price, which was a key driver of high yield in the first part of the year when we had that episode. But looking forward, as I said, risk compensation is much less narrow. And then there's still questions around liquidity, which, if the Fed did actually hike rates more aggressively sometime next year, if growth improved, that may be problematic for the high yield market.